closing bell on Wall Street, and now it's market domination overtime. Catalyst Funds' David Miller is still with me. He's going to be back with me in a moment to talk about the action. I'm going to start with where we finished the day here. Remember, it is obviously with the bell ringing at 1 p.m. It is a shortened trading day, and markets are closed tomorrow for the 4th of July holiday. So in advance of that, we got another little holiday present, I guess. That is records for the NASDAQ and the S&P 500. The Dow, not too shabby either, up 344 points on the day. We got a better than estimated headline number on the June jobs report this morning. And so that helping propel stocks higher. But already we have seen what Interactive Brokers' Steve Sosnick earlier this morning called a FOMO and MOMO market. That is a fear of missing out and momentum. So people kind of chasing things higher here. The S&P 500 finishing higher by 0.8% at a record. The NASDAQ composite up 1%, closing at a record as well. But that's not all. We got a lot of individual stocks at records as well. In large cap tech, Nvidia at another record, Microsoft closing at another record as well. I'm pretty sure Broadcom's there as well. If we're talking about the list here, just checking on the year to date, looks like it might have sneaked it out. We shall see when we look at all the closing numbers. And then as we pointed out earlier, it looks like Nvidia's market cap at an eye-popping nearly $3.9 trillion as it gets closer to $4 trillion. Microsoft at $3.7 trillion there. When we look at the sectors taking us higher on the day, it was indeed tech, information technology, but also the financials, where we have definitely been seeing a lot of outperformance as well. Here's the year-to-date for that group, up about 10%. I'm pretty sure that that one is at a record too. Let's look at the 10-year just to check. Yes, I believe that that one is at a record as well. So it hasn't just been all about large cap tech here that has been propelling things higher from the lows. It has been broader than that, including the likes of the financials. Industrials have also been outperforming as well. Let's kick it on back over to David here. So David, it seems like this market feels a little unstoppable in terms of the drift higher that we have seen. What do you think here about the second half of the year and what that trajectory looks like?
Well, I'm pretty bullish, but the reason why isn't that I think this is about fear of missing out or something to that effect, but rather I think it's like the release of a coiled spring. Meaning, if you think back a few months, there was tremendous fear around what was happening. China, the tariffs were going over 100%. If you look at what they're looking to do with budget cuts, Musk, along with Trump, was talking about cutting $1 trillion, even $2 trillion from the budget so they could run a balanced budget. Now they're doing precisely the opposite. They've said, we're going to have a big, beautiful bill. We're going to spend lots of money. We're going to stimulate the economy. There's very good reason to think that after you get that spring being coiled down, when they were talking about tariffs and extreme austerity, now they've gone to the opposite position. Markets have to adjust accordingly.
And so as markets adjust, right, at the same time, you know, we have this framework deal with Vietnam, but tariffs are still going to be 20%. We don't know what the final number is going to be for China. So is that adjustment going to be still, it's not the worst case scenario, so everything's fine? Or is that, you know, are we still going to have to price that in, that is going to be somewhat of a hit to some companies' profits?
Well, you do have to take it into account, but effectively it's all just one big math problem. So you can say, okay, what's the total cost to the economy of all these tariffs? And then you can look at that, that's probably a couple $100 billion. And then you look at the impact from making the tax cuts permanent. You look at the impact of spending trillions of more dollars in the economy, and it's tremendously on the other side of the equation that this is very stimulative, what they're doing on net. Anything in terms of tariffs on an incremental basis to both China and to Taiwan or even across the globe is pretty de minimis compared to the stimulative effect.
All right, let's get another look at what investors are saying right now, because as stocks hit record highs this year, the appetite for risk is lingering despite some of this uncertainty. Joining us for the weekly Yahoo Finance Investor Playbook, senior reporter Allie Canal. So Allie, what are you hearing?
Yeah, well, you were just talking about it, Julie. Speculative trades, retail-driven FOMO, a lot of that has been driving elements of this rally, especially since those lows that we saw in April. In fact, some of the riskiest corners of the market, from unprofitable tech to crypto, even penny stocks in some instances, have surged over the past few months despite those shaky fundamentals. And Palantir and Supermicro, for example, often considered meme stocks. These are heavily shorted names in the S&P 500. They've outperformed the broader index this year. In fact, they are two of the best performing stocks in the benchmark index. In addition to that, we've seen recent IPOs like Circle, CoreWeave. They've skyrocketed since their debuts, up 300% or more in some of these cases. And then nearly 420 stocks in the Russell 3000 have gained over 50% since early April. And of those high flyers, only 4 are profitable. That's according to data from Bespoke. So a lot of momentum-driven trades here. We asked Wall Street strategists about the latest moves this week. Here's a bit more of what they told us.
There probably is some complacency that has crept in. It's been an interesting move off the intraday low on April 9th because it's had retail traders' fingerprints all over it, with the different cohorts within the market performing as well as they have, much better than the S&P. Areas like retail favorites or meme stocks, non-profitable tech.
Well, it's the gamification of the financial markets that we've seen over the last 5 years. It's a concern, a considerable concern. Not to beat up on the cryptocurrency markets, but that too, there's a lot of speculation there. Buyer beware.
So a warning there of getting too detached from the fundamentals. Steve Sosnick from Interactive Brokers, he said this week that Momo and FOMO are likely to dominate until proven otherwise. He says that investors are chasing gains, not necessarily earnings. And for now, the party powers on. Still, that's not to say that the risks that are still very present in this market, that they won't materialize, especially as we get later into the summer and we have a little bit more clarity on the tariff and tax bill front as well. So plenty of unknowns remain here. And there is this cautiousness among Wall Street strategists of getting too ahead of your skis when it comes to this rally. Even today, we saw that stable jobs report number, but there were cracks underneath the surface. So the current state is that we have these record highs. The Mag 7, a lot of those mega cap names have been performing very well, but so have a lot of these speculative trades here. So a bit of caution about maybe some potential headwinds to come and potentially some frothiness in this market as we head deeper into the summer here, Julie.
Yeah, we'll see how it all works out. Allie, thank you. President Trump is on the verge of a big legislative win, with his tax bill likely to pass Congress soon. He's announcing some trade deals and boasting about a solid jobs report. Is he on a roll or about to peak? Here to discuss, Yahoo Finance's senior columnist, Rick Newman. So, Rick, what do you think? Where do you stand on that question?
I think it's both. I think he is on a roll. I think you can't deny that he's on a roll, but I think that this may also be the high watermark for Trump. First, he is likely to get this tax bill signed. If it doesn't happen over the weekend the way he wants it, it'll probably happen by mid or late July. But I think it's probably going to happen today. He's getting a trade deal here, a trade deal there. Look at what we're talking about here on air. New stock market record highs. We had a decent, good enough, you might say, job report for June. All the economists who are looking for the damage being caused by the Trump tariffs are not really finding it yet. So things are coming together for Donald Trump at the mid-year point here in 2025. But for reasons that Allie was just hinting at, this could be as good as it gets. I think the tax bill is already unpopular, and it could get more unpopular because of those cuts to Medicaid and to food benefits, in a sense that the tax cuts just really benefit the wealthy. And we could see weakening in other parts of the economy. So, politicians, they should enjoy it while it lasts.
I'm sure they're resting on their laurels and sitting back now. Rick, probably not. But, what are some of the other risks potentially going forward that would indicate that, obviously, as you've talked about, Trump has notched several wins here. What are some of the risks going forward, kind of besides the bill being unpopular?
I think that they would be a continuation of many of the risks that we've already seen. So we know this bill is going to add around $4 trillion to the national debt on top of all the other spending that will add to the debt. We've already seen this year that is causing some fissures in the bond market. So that means interest rates potentially higher than they would otherwise be. The pace we did have a decent jobs report today for June, but the whole job growth has been slowing. It's much slower now than the pace of job growth in 2023 and 2024. And the tariffs are not gone, even though we are not yet seeing the effect or the impact of tariffs on retail prices at most stores. That is real money that importers are paying today, and that has to ripple. It just has to ripple through the supply chain to the end users at some point. We're going to start to get a sense of this with the second quarter earnings reports that start to come in mid-July, and companies starting to explain how are they dealing with the higher tariffs. Is it coming out of their margins? Are they trying to pass it on? Because within the next few months, that's when all the inventory, pre-tariff inventory, is going to be gone. Companies are going to have no choice but to pay the tariffs, and that's going to ripple through the economy. So we're going to have a weaker economy probably in 6 or 12 months than we have now, but enjoy what we have today while it's here.
I'm eagerly awaiting those second quarter earnings reports, Rick. Thank you very much, and have a great holiday.
Julie.
Thanks.
You too.
Now time for some of today's trending tickers. We're watching shares of Lucid, Alibaba, AstraZeneca, and Summit Therapeutics. Up first, we've got Lucid, the electric vehicle maker on the rise. It reported new records for deliveries in its second quarter. The luxury EV manufacturer sharing a 38% year-over-year increase, highlighting how new vehicles and models are important for the industry. In spite of this record, analysts say that results didn't meet expectations. They were looking for, on average, 3,600 deliveries, so it was a miss of just under 300 vehicles. On the other hand, analysts at BNP Paribas out with an interesting note in which they said that some of the pure play EV makers like a Lucid, like a Rivian, like a Tesla should benefit as some of the OEMs back away from that business with the phase out of the EV tax credit. So kind of interesting there. David Miller of Catalyst is still with me. Are you guys in any of the EV companies, and do you think it's a good investment going forward?
Yes, but only Tesla. So when you look at Lucid or Rivian, you have this really big unit economics problem. And whether or not analysts were saying they beat estimates, I guess it was good news for today for the stock. But when you look at a bigger picture, they're on path to lose over $2 billion in operating income over the next year. There's a way to get past that, and clearly Tesla did it, but it's a scale game. You need to figure out how to make a lot of cars to make those unit economics work. And neither Rivian nor Lucid has figured out how to do that, nor do they have the ability to go out and raise a lot more money when your stock price for Lucid is like $2 a share. You can't go out and do big secondaries.
But if you're holding up Tesla now as the example of where you want to be invested, even Elon Musk says don't buy us as an EV company. And they're not a very good EV. I wouldn't say they're not a very good EV company right now. They're not as good an EV company as they were, certainly, with some of the declines that we have seen.
Absolutely. The really big question you have to ask yourself, or just ask of the future, is what does the future look like for Tesla? And the really big question is, 10 years from now, do people own cars, or are people using robotaxis? If it's much easier to sit there and not drive, the robotaxi takes you where you're going, and Tesla makes all of those, and they dominate that industry, and they're a monopoly, they're going to be dramatically bigger than they are today.
Yeah.
If you think about what the company is today, it can't look like that. Either it's going to be a very much smaller, not very interesting business 10 years from now, or they're going to win that game, or they'll be one of a few players in that game.
Right. Still a lot of ifs, I guess, in that equation. We'll
Certainly.
see. Meanwhile, the Chinese technology company Alibaba announcing it's going to raise $1.5 billion in exchangeable bonds in an effort to bolster the company's cloud infrastructure and global commerce operations. Those bonds will be tied to Alibaba Health Technology. The debt offering the newest move by a company that made the largest dual currency bond issuance in the Asia Pacific region in 2024. And we've also seen some of the other Chinese tech companies using these exchangeable bonds to raise money. I don't know how to look at this from an investment perspective. Is it just another way to raise money? And we're sort of, it doesn't matter how they raise money as long as I don't know. How do you think about this kind of situation?
Yeah, well, it's a tricky question because it's not unique to Alibaba. I think the bigger question you have to ask yourself is, if you look at the business of Alibaba, they've doubled earnings over the past few years. So that's great. But then the bigger question you have to ask yourself is, if you own a company in China that's a very large company in China, do you really own that company, or does the CCP really own that company? And are minority shareholders ever going to get the benefit of that growth in earnings. I think that's why the stock price hasn't done well in spite of the massive earnings growth you've seen. But that's kind of the existential question you have to ask yourself about, frankly, any large Chinese stock.
Right, no matter what they're doing or how they're raising money. And then finally, Bloomberg News is reporting that a deal is in the works between AstraZeneca and Summit Therapeutics over a lung cancer drug, and that would potentially be worth $15 billion over time. It would license Summit's drug to AstraZeneca. Summit's been in talks with other partners over licensing that treatment. The deal can still fall through, or Summit can choose a new licensing partner. But if the two parties agree, AstraZeneca and Summit, this would be the second multi-billion-dollar deal since June for AstraZeneca. And it's interesting here to me, David, that we're seeing more of these sort of licensing deals that aren't outright acquisitions. Are you in the sort of pharma biotech industry at all? And how do you look at these kinds of deals?
So I've followed that name, but I don't own it personally. Mm-hmm. I mean, look, it looks like they have a better drug than the Merck drug, the Keytruda, and it looks like it's done better in the trials, and it looks like it could be very promising for AstraZeneca and for Summit. But clearly, the pharma industry has decided they're not going to do the R&D themselves, and they're going to go to these companies like a Summit to build the products, and they'll focus on being the distribution arm. But it makes it kind of a difficult industry to evaluate.
Yeah. All right, David, thank you so much for being here. Really appreciate spending the last hour and a half with you, hour and a quarter with you as we talk about some of these themes. Appreciate
Absolutely,
it.
likewise.
Thanks. Have a great holiday weekend. Coming up, 4th of July celebrations often center around one of America's most cherished summer traditions, the backyard barbecue. But what kind of impact could this have on your wallet this year? We're going to speak to an expert on the other side to discuss. Stick around, much more Market Domination Overtime still to come. Wells Fargo releasing its 4th of July food report, and it might be a little pricier for Americans to host a barbecue this weekend, with the average cost for 10 people rising to $130 this year. Joining us is one of the authors of that report, Michael Swanson. He's chief agricultural economist at the Wells Fargo Agri-Food Institute. Thank you so much for being here. Obviously, this is very much on people's minds, especially after the past few years that we have had of rising prices. So what stands out to you as being sort of the bulk of the increases that we have seen?
Well, it's a question of the haves and the have-nots. So the haves for inflation are beef and eggs. I think everybody's aware of those. They've been in the headlines. But the numbers are there. 7.4% for hamburger year over year up. Eggs, depending on where you want to choose the point, 40%. Now they're less expensive protein. So those are the haves. But we're seeing some good values out there. Poultry, for example, boneless, skinless, chicken breast up 1% up from a year ago. So you just have to choose what you want to put on that grill.
What you want to put on the grill, or I guess on the table of sides, right, Michael? Because some of those sides either have not seen huge increases, or in some cases are actually heading lower here. I was looking at like fruit salad, for example. You want to go out and buy some watermelon, I guess, because we've seen prices pretty tame there.
Absolutely. What we're seeing is kind of a result of California having some good years. The water supply in California has been good. And it doesn't take that many more acres in California to produce good fruits and vegetable crops. And so we're actually seeing the CPI numbers around fruit and vegetables declining year over year. And we're seeing great quality. We're seeing great produce come out of that market.
If people are baking or making deviled eggs, for example, we know how sort of eggs have become this hot button issue. And there has been some relief from the highs on the egg front. But if you look at year over year, egg prices are still up quite a bit, right?
They are, and that reflects the fact that we do have a lower supply. We're about down 4% on a per capita basis. And so you're going to see that when you have an item like eggs, which are very indispensable and relatively not that expensive, they can see some amazing price spikes in the short term, especially a little bit of hoarding going on earlier this year.
Michael, we've seen all the headlines about tariffs and their potential effect on some food items. But you who have followed the industry, how much of the price increases we have seen are about tariffs? How much of them are about sort of normal agricultural cycles, for example? I mean, eggs, right, had to do with bird flu. That didn't have to do with tariffs. But how do we think about the different categories?
We're really blessed with a super abundance of food in the United States. Very few of our foods are imported. We can pick them out, avocados, coffee, things like that, bananas. Those are the ones we know about. But the majority of food is U.S. based, especially during the in-season. What really drives food inflation right now is labor costs. And that's one of the things the Federal Reserve is watching as well. So we see the labor costs at the supermarket and at the restaurant. We're seeing it at the factory, and we're seeing it in the farm fields. So almost every aspect of food inflation right now domestically is about that labor cost, which never gets cheaper, but it's offset by productivity and yields.
And what is happening in the fields in particular in that equation, given the changes that we have seen to immigration policy over the last several months? Have we seen shortages of labor in some of those cases and labor costs go even higher?
Not really. There's a renewed focus on the three avenues. One is going to be make sure you do E-Verify. Second is H-2A visa labor. And then third is automation and technology. I spent a lot of time out in California with my colleagues, and they're trying to make it easier and more, accessible to work in those fields through shade, water, all those things. So those three avenues are really what's the focus right now across the country.
And to get back to the prices of different items that people are buying for this weekend, or really for barbecues throughout the summer, right? It's not exclusively a July 4th kind of activity. Do you see sort of changes in consumer behavior based on price at this point, or have consumers become accustomed over the past couple of years to prices sort of rising consistently?
They're accustomed, and they have the jobs and the income to afford it. When you look at the retail price of all three of the major meats versus the hourly wages right now, chicken's at an all-time affordability for high, so is pork. And beef is actually more affordable than the 2015 spike that we saw about a decade ago. It's really surprising to people in the industry as well that the consumer's purchasing power is so strong relative to those retail prices.
Michael, what's your favorite barbecue item?
It's going to be carnitas because my wife makes it.
Ooh, I like that. That was not an expected answer. I like it. Michael, thank you so much and happy 4th.
Excellent. Have a great day.
Thanks. Time now for what to watch in earnings. We're keeping our eye on Delta, Conagra, and Levi's. Let's start with Delta, set to release its second quarter earnings on Thursday before markets open. The airline company beating earnings estimates in its previous two reports, establishing an expectations that Delta's earnings will surprise going forward. Analysts are becoming more bullish on Delta's prospects, even though the company's revenue growth is expected to stall. Conagra Brands releasing its fourth quarter earnings also on Thursday before markets open. Analysts forecast the packaged food company to report a decline in EPS year over year. Conagra has been underperforming amid weakness in sales, the company feeling the weight of supply constraints and supply chain challenges pressuring volume. And finally, Levi Strauss reporting second quarter earnings on Thursday after the markets close. The apparel manufacturer beating earnings per share for the last 4 quarters, but analysts do expect a decline to Levi Strauss's top and bottom lines. Revenue is expected to drop from the same quarter last year. Levi is experiencing challenges as well from supply chain disruptions, as well as inflation and economic uncertainty. And let's do a final check on the action from today's session. Stocks did post fresh records. Investors also, of course, digesting that stronger than expected June jobs report that dampened hopes for a Federal Reserve interest rate cut, at least in July, maybe in September. We saw those Fed Fund futures pricing in lower chances of a cut across the board. The NASDAQ, the big outperformer of the day, up 1% as we saw new records for NVIDIA as well as Microsoft. And NVIDIA with that price record, also seeing a market cap record in today's session of nearly $3.9 trillion. We saw tech and financials lead the gains within the S&P 500, which rose to a record as well, up 0.8%. And the Dow, coming into the session, was about 1.2% below its all-time record close. So it's inching a little bit closer to that level with that 0.75% gain today. That'll do it for today's Market Domination Overtime. Be sure to come back Monday, 3 p.m. Eastern, for all the latest market-moving stories affecting your wallet. Have a great weekend and a safe and healthy and happy 4th of July.